Theo, better numbers but still under pressure at this stage, our manufacturing sector.
Good afternoon. Yes, the point is, it is a better number on last month's number. Remember, this index is based on a month-to-month comparison. And we are down from the previous month. We're below 50. That means that the sector, the manufacturing sector, is contracting for the second month in a row. But yes, the rate of deterioration has eased. We ticked up slightly. Unfortunately, we're still below 50, which means that the sector as a whole is contracting, not picking up.
Of course, there was talk in June's numbers that there was a bit of a World Cup effect in there. Of course, productivity coming to a halt almost during the World Cup. Do you think there's still a bit of a World Cup hangover in July's figures as well?
Look, that's difficult to say. The business activity number, the segment business activity actually picked up nicely. Now that specific segment was negative or down in both May and June. May we had Eskom strike, the Transnet strike, and June we had the World Cup. So those numbers were actually negative, and business activity picked up, which is one of the strongest factors why we have a slight pickup in the numbers. The one that was negative was the sales orders going forward. So if you look at those numbers that look at going forward, that in effect deteriorating. That was a big factor why the increase was not really breaching the 50 level, which means that the sector would be expanding if it's above 50. On the other negative side is we saw that the unemployment category for the third month in a row is below 50, which means that the manufacturing sector as a whole is still shedding jobs.
Well, Paul, your company has holdings in a number of manufacturing businesses: food, leather, footwear, fibres, automotive products, just a few of those. Where are you feeling pressures in your business at the moment?
Even I think particularly in the footwear sector and in Gladina towels, these are areas where obviously the rand does have an effect, and it becomes a little bit more difficult to compete when the rand is as strong as it is. But automotive is picking up quite nicely. We've had a bit of an increase there due to increased exports, and certainly in our PET division, it's a lot stronger at the moment.
So, Paul, do you mean you're finding it difficult to compete with cheaper exports in the footwear and towel business?
Yeah, I think our strategy is that we've unfortunately had to import more footwear under our brands. And obviously this has an effect on local employment, which is a bit of a pity. But volumes aren't necessarily down. It's just a switch to imported footwear under the brand rather than manufactured locally.
And of course, Theo, this must be affecting lots of our local manufacturing companies. With the rand so strong, it's often cheaper to bring in things from overseas.
Yes, if you look at, remember this is the manufacturing sector. So what Paul is saying, if you look at the manufacturing sector as a whole, and if you relate that to consumer demand and consumer spending, what we are seeing is there might be a shift from locally manufactured goods to imported goods because of the strong currency. Now that type of factors is negative for the manufacturing industry per se. My view is that if you have these lethargic PMI numbers going forward, as we've seen out of Europe and the East, and the strong rand, it brings the case of an interest rate cut back on the table again. We will have another set before we get the MPC meeting in September. But based on the fact that although this is the rate of deterioration is slightly better, underlying we are still contracting in terms of the sector.
Well, Paul, what would bring relief to manufacturers such as yourself? Would a weaker rand and even lower interest rates assist?
Even lower interest rates, definitely, because I think all manufacturers have some element of borrowing. So, I mean, obviously that would give a fair bit of relief, and one could be a little bit stronger in terms of capex and a little bit more committed to that type of expansionary environment. But the rand, until such time as there's a change in policy, I think we as manufacturers have to accept that, our rand is very volatile and is going to be influenced by commodity prices and by stock market movements, etc. So we have to set a strategy that takes that into account. And in our case, really what we've said is that we have to accept that, like 2001, the rand got very weak and then it slowly got stronger again. The profile this time around is very similar. And until such time as we see a major shift in policy in terms of interest rates or whatever, we have to accept it. And we must make sure that we don't compete in the price war. We try to differentiate in our manufacturing, and we also try to be as competitive as possible. And that means more automation, unfortunately, which is not good for labor.
Well, just talking about labor, Paul, I mean, are you employing people at the moment? Do you have the confidence at this stage of the recovery to be hiring?
No, we're not. In fact, our labour numbers are virtually the same as they were a year ago. And if I go back 2 years, we're down 1,500 people. So it's a sorry state of affairs, unfortunately.
Theo, of course, we had those jobless numbers out last week. I think there was about 53,000 jobs lost in the second quarter of the year, unemployment at 25.3%. Do you think that it's going to be difficult to get back to where we were a couple of years ago? Just going with what Paul's been saying, that they are automating and jobs aren't going to be recreated.
Well, if you look at what the PMI is telling us, this is the third month in a row that employment numbers is below 50. Therefore, that employment is contracting in the sector. Now, if it's below 50, that means there's obviously jobs being shed in the sector. Given the strong rand in the last 2-3 weeks or even month or two, I think that will exacerbate that problem. And I do think we need a bit more than just an interest rate cut for the employment situation to turn around. That's not going to turn around purely on an interest rate cut. Unfortunately, there's not a lot of other tools left. If you then add the fact that the world PMIs, bar perhaps for India, the world PMIs is very mixed this morning or today in terms of they're all in or around 50%, which is the key number for South Africa, for us. The big countries that we export to, they are all struggling around that number. So I don't foresee a major uptick in the next month or two. However, it does point that there's not a major panic situation in the world, and that's why I think markets today were stronger. The key is we are going to take longer to start to recover from a manufacturing point.
Well, Paul, when would you expect a sustained improvement in business conditions?
Well, cautious, I think, for the next 12 to 18 months, but I think after that we do see an improvement. I mean, there's no doubt that long-term vehicle build in South Africa will grow, and PET is a strong market for us as well. So I think we've been cautious for the last 12 to 18 months, and we remain as such. We've just got to generate cash and watch the costs. And that's our strategy. We're not expecting a huge uptick in volume in the next 12 months or so.
Would you go along with that, Theo? Do you
Yes.
think 12 to 18 months before we do see that sustained improvement?
Well, look, I hope it's earlier. But if I look at the underlying numbers and I look at the fact that the indebtedness of the South African consumer, the fact that the world economies is not really starting to pick up, that our economy is picking up. But if I look at these numbers, it means that we will start the third quarter almost on a kind of a subdued note. So yes, it will take time. Hopefully it's shorter than that timeline, but certainly not in the short term we won't see a pickup.